Cash and cash equivalents. So cash and cash equivalents are basically financial assets with the highest amount of liquidity. Financial assets with the highest amount of liquidity. Now, being financial assets, they are either recorded in amortized cost, or fair value. Fair value means price at exit. Now, to understand what stands for cash equivalents, cash we understand already. What stands for cash equivalents, we take a few examples. So, examples of cash equivalents are treasury notes, money market funds, commercial papers, etc. etc. They are generally within a maturity of 3 months. These are cash equivalents. They are so close to maturity, basically the amortized cost or the fair value do not fluctuate much. They do not make much of a difference. Even if interest rate, their risk to interest rate changes is basically next to nil. So this is what cash equivalents are. And cash obviously is cash. Marketable securities. These are treasury bills, notes, and equity instruments like stocks, like mutual funds, like ETFs. Basically, these are securities that can be bought and sold in open market. That is, there is a market for it, where they can be bought and sold. So they are highly liquid. Receivables. Receivables are basically, you have made the sales, but the cash is yet not received. This is basically what is receivables. Now, there is something called gross receivables and there is something called net receivables. Net receivables is basically gross receivables adjusted for doubtful accounts or uncollectible accounts. Now, this adjustment, this doubtful account or uncollectible account is basically called a contra account. Contra account. This is created as a contrary to receivables so that this works as an adjustment and gives us a net realizable value. This gives us a net realizable value. Now, a few things are very important to note, friends. For example, the doubtful accounts, the value of them should not be fluctuating too much. They should be stable as a percentage of the gross receivables. If that percentage is very volatile, you must understand there is something wrong going on, at least temporarily, if not permanently. Then there is something called receivables to sales ratio. This should not trend upwards. It should not trend upwards. If gradually the receivables is increasing as a proportion of sales, there must be something wrong with the credit policy. Some sales are being pushed unnecessarily to show high figures of revenues. Maybe. It may be. So these are two factors that you have to recognize. Then the third thing is concentration of clients. Concentration of clients. High concentration of clients means high concentration of credit risk. So if there are 3 customers only and they give you equal chunk of your revenues, then if one of them fails, that means 33% of your revenues are gone. So client concentration is a very important thing that one has to check in terms of assessing the probability of return of revenues and what percentage loss is probable. Now we come to inventories. So friends, inventory is having different standards with respect to IFRS and US GAAP. Let us consider them separately therefore. So for example, under both IFRS and US GAAP, inventory is valued at lower of cost or net realizable value when the method of inventory collection is not LIFO. So inventory record is lower of cost or net realizable value, provided that it is not, LIFO method is not being applied for inventory liquidation. Now, what is net realizable value, friends? Net realizable value is selling price minus cost to sale minus fulfillment expenses like completion expenses. This is the net realizable value. This or the cost, whichever is lower, is basically the recorded value at the inventory line item. This is for both IFRS and US GAAP. US GAAP, there is one provision here. When there is LIFO method being used, the option is either cost or market value. Market value is defined as current replacement cost. So lower of cost or market value is going to be the value of the inventory. LIFO is not allowed in IFRS. It is allowed in US GAAP. Now, let's say the carrying value of the inventory has become greater than the realizable value at a certain point of time. This will necessitate write down. Write down means you reduce the carrying value to the right value where it is fair, the amount is fairly reflected. Now this write down can be reversed if the valuation again is increased. This can happen under IFRS. But this reversal cannot happen in US GAAP. Once you have put it down, once you have written it down, you cannot reverse that write down. Not allowed. The inventory methods used under IFRS are FIFO, weighted average costs, and specific identification method. Right? LIFO is not allowed. Under US GAAP, LIFO is allowed. So here you can do FIFO, you can do LIFO, you can do SIM, you can do WAC. So that's all about inventories. Other current assets. Other current assets are basically those items which do not entail separate line item mention. So they are like miscellaneous assets. So one example for this can be prepaid expenses. Let's say you have next 12 months monthly premiums to pay for an insurance. Right? What you do is, this starts from January. What you do is 31st of December, you pay the entire thing. You make the entire payment. Now this becomes an asset, and that asset can be called a prepaid insurance expense, because the payment time or the payment schedule has not yet begun. It is going to begin from the next year, but you have already paid for it. So you create an asset against it. And as the premium timings come due, you reduce from the asset the premium amount accordingly. So that's how other current assets function. There can be various other miscellaneous current assets which do not entail separate line item mention. They all are under the other current assets umbrella.